Price action explained. Swing trading NASDAQ E Mini futures contracts for 100 plus point gains. Welcome back to the channel. My name is Yu, a professional trader with many years of experience under my belt, and I've been navigating the tumultuous waves of the futures markets. I am on a mission to keep you profitable in day trading by exploring critical concepts and strategies. Today's focus is on price action trading, a fundamental aspect of trading the NASDAQ E Mini futures contracts and an essential component of swing trading. Let's trade better together. In today's exciting new episode, we'll delve into the world of swing trading the E Mini NASDAQ futures contract. Our journey will be led by price action trading strategies, which will serve as our guide in the vast financial landscape. Join me as I secure over 100 points trading two of these NASDAQ E Mini futures contracts. As the trade unfolds, I'll provide an in-depth walkthrough of the price action trading strategies I utilize. Learn how you can harness these techniques for effective swing trading with futures contracts on the NASDAQ E Mini S&P futures. Don't miss out on this detailed examination of a real-world price action trading. Before we get started, let's examine this trade. In this trade that I've made over 100 points on the NASDAQ E Mini futures. As the price was in a steady uptrend, I decided to go short, entering at 15,216.50 points. You will notice that upon entering the market, I also immediately placed a stop loss order. It is important to remember that whenever you enter the market, you should always have a stop loss. This limits your risk and ensures that you do not get caught off guard. Getting caught off guard could lead to a massive loss because sometimes the futures markets can be volatile and we have no control over that as day traders. Upon entering the market short two NASDAQ E Mini futures contracts, with proper risk management in place, now it was time to let the price action take control. As a speculator, it was just my turn to watch the market participants ensure that the aggressive sellers would be able to continually push the price down and make sure that my risk was kept. After the price moved down a bit, I was able to move my stop loss to a position where I guaranteed some profits, and now it was really time to just let the market action play out. As I'll get into more details later, speculators or day traders do not have the ability to move the price. Therefore, we have to ride the waves set by the larger market participants. As the price action dictated to me, based on my experience, the market was in a strong downtrend. The aggressive sellers were constantly pushing the price down, and they were running through all the orders placed by the passive buyers. During this downtrend, you would see the price stall for a moment in a slight consolidation, but then it would just continue to be pushed down. The sellers were clearly in control, and these aggressive sellers were on a mission to drive the price down. I shorted the market at 15,216. My risk was about 15,220. That means I had about 10 points of risk on the NASDAQ E Mini futures. Now the price was around 15,138. It was consolidating. At this time, I was unsure if the aggressive buyers would come in and lift the price up, or the aggressive sellers would be able to keep pushing the price down. After a short while, it was clear that the aggressive sellers were still in control and they forcefully pushed the price down. As you gain experience trading the futures markets, you'll learn that sometimes when the buyers and the sellers are in battle, it's best to sit and watch. You should not be fearful as long as you're in a position where your risk is capped and it's just up to the market participants, or I should say, it's up to the larger market participants to do battle, and you're just riding the waves they create. Therefore, as a day trader or a speculator, it's your duty to cap your risk, enter, and let the market participants do the hard work. During this trade, the price entered consolidation a few times. Now, the inexperienced among us would most likely get scared and exit their positions, only to later enter and chase the price. This method of trading is unwise because not only does it increases your chances of making mistakes and having a loss, you will also get lazy and sloppy, forget to enter with proper risk management, or worse yet, you're racking up fees because every time you enter a trade, there are fees to enter the market. Therefore, it's better to take more calculated risks when you decide to enter the market. As the price continues to get pushed down by the aggressive sellers, many times it seems like the price is going to reverse, only for it to fail again. These times are often times when inexperienced traders get tricked into the market. They will try to buy the bottom in hopes of catching the rally all the way to the top, only for the market to reverse, take them out, and then possibly go in the direction they originally anticipated. With more practice and time in the market, you'll better understand when to enter, when to exit, when the market might be ready to stop and change direction versus when it's just a consolidation where the larger players are doing battle before it continues in the same direction or possibly turn around. These are all details that I will go into later in this discussion. Towards the end, it looks like the price is going to just turn around and go straight up before there's one final push, a large push to the bottom, and then the market starts to turn around. How many times have you tried to enter the market, place your stop loss at a place you thought was safe, only for the market to take it out and then turn around? These are the mistakes inexperienced traders make, and these are the mistakes that I would like to try to help you avoid. Let's trade better together. Have you ever heard about naked trading? What do you know about naked trading? Let's go into some detail. Naked trading, it means that you as a trader can identify the current market movement by price action alone, without the use of many technical indicators. Having too many technical indicators on the charts will lead to paralysis by analysis, where you, the trader, will consistently doubt yourself because oftentimes the indicators are giving you contradictory signals. This approach of naked trading is particularly relevant when swing trading the NASDAQ E Mini S&P futures contracts, where understanding pure price action is paramount. There are 6 main components when you're considering naked trading or price action trading. The first one is, of course, the price action. The second, support and resistance levels. The third, trend line and channels. The fourth, chart patterns, candlestick patterns, risk management. With these, you'll be able to become a proficient price action trader and rely less on indicators and learn how to anticipate market movements. Let's delve into price action. Naked trading hinges on analyzing the price action. Traders monitor the sequence of highs and lows, the formation of specific candles, or the patterns that emerge over time. This is based on the belief that price action patterns are likely to repeat themselves, offering opportunities to anticipate future movements. While this is not a guarantee, it offers an insight. and you'll learn to develop your skills in anticipating where the price should move and make better informed trades.